Hello, friends. Welcome back to Pocket Power. In the first part series, we learned how to identify the right stock using key financial ratios. Today, we'll take a deep dive in the next step of our investment journey, which is mastering the essential factors, diversification, sector selection, portfolio reviews, and so on. Let's start with the first point, which is portfolio diversification. This is, don't forget, the basic golden rule of investing. A well diversified portfolio minimizes risk by spreading investments across sectors, geographies, and asset classes. You need to ensure that not a single sector should occupy more than 15% of your portfolio. This is how you can protect from downturns in one area while allowing the other to capture growth. Second important point is how to choose the right sector. In case you have a short-term goal, I mean, you're saving for an event which is, in 3 to 5 years, you could focus on stable sectors like fast-moving consumer goods and utilities. However, if your intent is to save for a medium-term goal, say 10 or 12 years later for your child's education or something, then you could look at something like medium-term sectors like IT, pharma, and financial services. However, if the intent is slightly towards retirement planning and maybe longer term goals, which span 15 years, 20 years plus, then you should look at high growth sectors like technology, clean energy, and healthcare. Remember that every investment should serve a purpose for which you are investing. Clearly define your financial goals, and based on the tenure of your goals, you need to invest in the sectors. Being consistent is the core to the investment philosophy for any portfolio. Hence, consistency in investing is much more important than even the timing of the market. So, whatever you are doing, whether it's investment in SIP or in shares, ensure that you do it consistently. Over a period of 10 to 15 years, if you follow this philosophy, this approach would outperform itself. Please automate your SIPs to maintain this investing discipline. Regularly reviewing your portfolio is indeed very vital. You need to ensure that at least once a year you are reviewing your portfolio so that you are on the right path to ensure that your investments are aligned to your financial goals. In case there is a need to rebalance across sectors, you need to do that once a year minimum. For example, if there is an economic slowdown, you could shift from cyclical sectors like infrastructure to defensive ones like healthcare, which can protect your portfolio. Emotions are the biggest challenge for any investor. Hence, we need to avoid panic selling during market crashes or getting caught in any hype of overvalued stocks. Remember, your focus should be on your long-term and short-term goals, and stick to your investment plan, review regularly, and stay disciplined. To summarize, diversify your portfolio to minimize your risks. Choose sectors based on your investment goals. Set clear goals and stay consistent in your investments. Review your portfolio regularly and avoid emotional decisions. That's all for today. Please ensure that you continue to invest, and that's how you will build wealth. Thank you for watching Pocket Power. Stay tuned.